The role of news and events in trading decisions is often misunderstood because traders tend to focus on information itself rather than on how markets respond to it. News feels powerful, headlines feel urgent, economic releases feel decisive. Yet trading literature written by practitioners who have survived multiple market cycles converges on a quieter truth. News does not move markets as much as positioning expectation and surprise do. The same piece of information can trigger a rally, a sell-off, or nothing at all, depending on what the market had already priced in and how participants were emotionally positioned before the event occurred. At a fundamental level, news and events act as catalysts, not causes. They accelerate reactions that were already building beneath the surface. A strong earnings report after weeks of accumulation often triggers continuation, while the same report after a euphoric run-up may mark exhaustion. Central bank decisions rarely shock markets because the decision itself matters less than how it compares to consensus expectation. Trading literature consistently emphasizes this distinction because traders who focus on the content of news often miss the more important signal, which is the market's reaction to it. Reaction reveals imbalance. Content only provides narrative. One of the most common mistakes traders make with news is treating it as directional guidance. They assume good news should push price up and bad news should push price down. This assumption creates emotional whiplash when the opposite happens. In reality, price movement after news reflects the gap between expectation and reality. If good news fails to produce upward follow-through, it is not irrational. It is informative. It suggests that buyers are already committed or that sellers are stronger than expected. Traders who learn to read this asymmetry stop arguing with price and start learning from it. Another critical role of news in trading decisions is its impact on volatility. Scheduled events such as economic releases, earnings, or policy announcements often compress and then expand volatility. This expansion changes the entire risk landscape. Stops that were reasonable minutes before the release may become meaningless afterward. Spreads widen. Slippage increases. Trading literature repeatedly warns that news does not just change direction, it changes conditions. Traders who fail to adjust position size and expectations accordingly often experience emotional trading, not because their analysis was wrong, but because their risk assumptions were outdated. Experienced traders also understand that not all news is equal. Markets respond most strongly to events that challenge prevailing narratives. Routine data releases that confirm expectations often produce little movement. Unexpected deviations, guidance changes, or shifts in tone matter far more than the data point itself. This is why many professionals focus less on reading news in real time and more on understanding the dominant narrative beforehand. When you know what the market believes, you know what kind of news can actually matter. Another subtle but important insight is that news often functions as an excuse rather than a driver. When markets move sharply, narratives are retroactively assigned to justify price action. Trading literature frequently highlights this backward storytelling bias. Price moves first. Explanation follows. Traders who rely on news explanations risk anchoring themselves to stories that have already lost relevance. Those who prioritize price behavior remain flexible. They accept that markets do not need reasons that make sense to them personally. This does not mean news should be ignored entirely. News defines context, risk windows, and no trade zones. Knowing when major events are scheduled allows traders to avoid being surprised by sudden volatility. It informs decisions about whether to reduce size, tighten exposure, or step aside altogether. The professional use of news is defensive rather than predictive. It helps manage participation, not forecast outcomes. Another role of news and events is psychological. They amplify emotion. Fear during negative headlines and greed during positive ones spread quickly through markets. This emotional contagion creates overreactions that can present opportunity, but only for traders who are prepared. Trading literature often notes that the best opportunities around news arise not during the announcement, but after the emotional spike fades and structure reasserts itself. Patience, not speed, is what turns news-driven chaos into tradable clarity. Over time, mature traders develop a disciplined relationship with news. They stop consuming it obsessively. They filter aggressively. They respect its ability to change conditions, but not its authority to dictate decisions. They observe how price behaves around events and treat that behavior as information rather than validation of a story. This posture protects them from emotional hijacking and narrative attachment. Ultimately, the role of news and events in trading decisions is not to tell you what to think, but to tell you when to be careful, when to reduce exposure, and when to pay closer attention to how the market responds. News is most useful as a volatility and expectation signal, not as a directional command. And it is precisely at this point, when the trader shifts focus from what the news says to what the market does in response to it, that news stops being a source of confusion and becomes a contextual tool that supports disciplined decision-making, rather than undermining it. And this is where the deeper exploration of how to work with news and trading has not yet fully reached its end. Because once traders stop asking what the news means and start asking what the market is doing with it, their relationship with information changes fundamentally. News becomes less like a command and more like a stress test. It tests positioning. It tests conviction. It tests whether price can move in the direction the story suggests or whether that direction has already been exhausted. This shift is critical because markets rarely turn on information alone. They turn when information fails to produce the expected response. At this deeper level, traders begin to notice a recurring pattern around major events. Before the news markets often compress as participants wait. During the release, volatility explodes as emotion and algorithms collide. After the release, the most important phase begins the phase of acceptance or rejection. Does price hold the move? Does it fade quickly? Does it struggle to continue despite good news? This post-event behavior contains far more usable information than the headline itself. Trading literature often emphasizes that the real signal is not the spike, but what happens after the spike, when emotional energy starts to dissipate. Experienced traders also learn to differentiate between tradable news and untradable news. Some events create clean structural shifts. Others create chaos without direction. The skill lies in knowing when to engage and when to step aside. This discernment is built through observation, not prediction. Over time, traders recognize that trying to trade the initial reaction is often a low-probability endeavor unless the strategy is explicitly designed for that environment. For most traders, patience after the event yields clearer risk and better entries. Another important evolution is how news is integrated into risk management rather than entry logic. Traders may reduce size ahead of major announcements, widen stops to reflect volatility, or choose not to hold positions through events altogether. These decisions are not expressions of fear. They are expressions of respect for changing conditions. Trading literature consistently shows that many large losses occur not because traders were wrong on direction, but because they failed to adjust risk when the environment shifted suddenly. Over time, traders also become more selective about which narratives they allow into their thinking. Not every headline deserves attention. Not every analyst opinion matters. Mature traders track a small number of macro themes or scheduled events that are relevant to their markets and ignore the rest. This selectivity protects cognitive bandwidth. It prevents emotional whiplash. It allows focus to remain on execution rather than interpretation. News becomes a background variable, not a constant intrusion. There is also a powerful psychological benefit that emerges from this approach. When traders stop relying on news for direction, they stop feeling betrayed by it. The market is no longer wrong for reacting differently than expected. Instead, every reaction becomes information. This reframing reduces frustration and preserves emotional stability. Trading literature often notes that emotional resilience improves dramatically when traders release the expectation that markets should behave logically according to the story. As this understanding matures, news and events are seen less as opportunities and more as transitions. They mark moments when conditions change, when volatility resets, when new information is absorbed. Traders who respect this treat news as a reason to slow down, observe, and recalibrate rather than rush in. This restraint often feels counterintuitive in an environment that glorifies speed, yet it is precisely this restraint that separates consistent traders from reactive ones. In the end, the role of news and events in trading decisions is not to provide answers, but to create questions. Why did price fail to move on positive data? Why did it continue lower despite reassurance? Why did volatility collapse instead of expand? These questions guide observation rather than action. They keep the trader aligned with reality rather than narrative. When news is approached this way, it stops being a source of emotional disruption and becomes a contextual framework that enhances awareness without dictating behavior. Trading becomes calmer. Decisions become cleaner. Risk becomes more intentional. And it is from this place, where information is respected but not obeyed blindly, that traders learn to navigate event-driven markets with composure, patience, and adaptability, allowing price itself to remain the final authority, while news simply provides the backdrop against which that authority is expressed.